Hello, everyone. My name is Nevin Alhaz. I am with the Santa Clara City Library. Welcome to our Path to Home Ownership webinar. Today, our speaker is Alessandra from Habitat for Humanity. Thank you, Alessandra, for being with us today.
Thank you, Nevin, for having me, and I'm happy to be here and welcome everybody to our Path to Homeownership presentation. As Nevin mentioned, my name is Alessandra, and I'm a housing counselor at Habitat for Humanity East Bay, Silicon Valley, and I want to welcome you all. So just real quick, and Nevin mentioned this, but you'll be getting an email from Nevin with some handouts about today's topic, with a link to an evaluation form, and I believe the handouts are up on the website. Right. So you'll look for that email from Nevin. Before we get started, just a little bit about who we are. Habitat East Bay Silicon Valley is a nonprofit, and we serve people in Alameda, Contra Costa, and Santa Clara counties. Now, our organization is a HUD-approved housing counseling agency, and we offer a range of innovative programs and services that work to empower families, achieve financial fitness, invest in themselves, and change their lives. Now, our services include one-on-one counseling, financial education workshops, online financial education, and first-time homebuyer classes. With one-on-one counseling, we offer free individualized guidance by a HUD-certified housing counselor, and is available really to anybody who would like to learn how to manage their personal finances, which can include how to create a sustainable household budget, balance income and expenses, start a savings plan, manage debt. We also offer credit counseling that teaches how to build or rebuild positive credit history, as well as home pre-purchase counseling to help understand how the home buying process works and how to become financially ready to purchase a home. Now, providing financial education is at the core of what we do, so we also offer monthly financial education webinars through our website and also in partnerships, like the partnership with the Santa Clara Library. And also we teach the HUD-approved first-time homebuyer class. Now, we also offer affordable homeownership opportunities, and we build where we build new homes and renovate existing homes and then sell them at an affordable mortgage to qualified families. And we have home repair services. So if you would like to learn more about all of our programs, please visit us at www.habitatebsv.org. All right, but today we're going to be covering advantages and disadvantages of homeownership, preparing for homeownership, what lenders look for, and then we'll review some home loan programs and products. And just real quick, we'll have Nevin mentioned to write your questions on the chat box or the Q&A. Please feel free to do so. I will take time at the end of the presentations to take questions. Now, the home buying process really begins before you speak with a realtor or apply for a mortgage loan. It really starts a lot earlier, and the more you can do to prepare beforehand, the easier it will be for you to navigate it. Taking a HUD-approved first-time homebuyer class is probably the first step you can take. Many borrowers take it as a lender requirement to qualify for a particular loan or assistance program, often at the end of the process, of the home buying process, when they're about to close. But a better strategy is to take it early on, before you even start shopping for a home. Now, this 8-hour course reviews the home buying process, as well as how to prepare for successful homeownership. Even though you have to pay a fee to take this class, which varies depending on the organization that offers it, the money will be well spent. It's also important to understand all the costs that come with buying and owning a home, including ongoing and upfront costs and the responsibilities that you will have with maintaining your home in good condition. Taking the time to strengthen personal finances before buying a home, including creating a household budget, building savings, checking credit report, and reducing personal debt will all help prepare you for successful home ownership and maximize the chances your loan application will be approved. And there are various home buyer loan and assistance programs. So taking the time to research what's available and identifying those that may be an option for you will ensure that when you're ready to shop for a mortgage loan, you do so as an informed consumer. Buying a home is probably the largest financial transaction you'll make in your life. When deciding if homeownership is right for you, it's important to carefully weigh the pros and cons, both financially and in terms of your lifestyle. So for example, if owning a home means you'll no longer be able to afford even the occasional dinner out, or perhaps save to reach other financial goals, then you need to decide if homeownership makes sense or perhaps renting is better. Now, regardless of the answer, you'll be armed with knowledge and able to make the best choice for your family based on your priorities. One of the benefits of owning a home is that the housing costs are more stable than when you rent. While typically rent increases year after year, provided you have a loan that has a fixed interest rate, your monthly housing payment will remain the same until the loan is paid in full. Some costs will increase, like property taxes, but they typically don't increase as much as rent can or as often. And so it's easier to budget for your housing cost over the long term. When you own a home, you may also have tax benefits that you don't have when you rent. The amount you pay each year for interest and property taxes are deductible items. Deductions homeowners can take are capped, so you will need to talk with a tax accountant to see if it makes financial sense for you. But this is a benefit that may be available and that you do not have as a renter. Equity is another benefit of owning a home. Equity is the difference between what you can sell it for and what you owe. Over time, your home may increase in value, and as you make monthly payments, the amount you owe decreases. And with the increase in value and the decrease in your debt on the home, your equity grows. When you own a home, you have control over your environment. You get to decorate it the way you want without having to ask the landlord for permission. For example, you can have pets, and you can adapt your space to your individual style and needs. And there's also a certain sense of pride when you own a home. That's not to say you don't feel proud of your home when you rent, but buying a home isn't easy. It's a long process, and it's an achievement that people work hard to obtain. So there's a feeling of accomplishment when you reach the goal of homeownership. But there are also disadvantages that you must carefully consider. Buying a home is a long-term financial commitment. It requires careful budgeting because not keeping up with all the costs associated with the home carries serious financial and legal consequences. Not only do you risk losing your home and investment, if you end up foreclosing, your credit history will suffer greatly and it will take a long time to recover. When you take a mortgage loan, you'll have housing expenses that you don't have as a renter, and you need to make sure you can keep up with all these costs. In addition to the mortgage payment, you'll have to pay for utilities, property taxes. When you rent, although renter's insurance is highly advisable, you're not typically obligated to purchase it. As a homeowner, your lender will require you to carry it and keep it current or face added costs and even foreclosure. Homeowner insurance is also a lot more expensive than renter's insurance. If your home is in a homeowner association, you'll have to pay HOA dues, and these go towards paying for things like repairs and maintenance of common areas. Now, the dues can be several $100s a month, so it's important that you review this cost to make sure you can afford it. And if you put less than 20% down as a down payment, then you'll have to pay mortgage insurance. You also have high one-time upfront costs that you must cover before even getting the keys to the home. You'll have to pay a down payment, which depending on the loan program can be anywhere from 3 to 20% of the purchase price of the home. You have to pay closing costs, which is a rule of thumb are usually about 2 to 5% of the purchase price. In addition to moving expenses, you may need to buy appliances like a refrigerator or a washer and dryer. Now, keep in mind that it can take 3 to 5 years to break even after paying these upfront costs. So it's important to consider how long you plan to live in the home. You also have decreased mobility when you own a home because it's not so easy to pick up and move. When you rent, generally the longest time you commit to live in the home is 1 year, and often is a month-to-month commitment. So you can move by just giving a 30 days notice. When you own a home, if you have to move, you would have to sell it before you're no longer obligated to pay the costs associated with the home. Now, that means that you may not be able to afford adding a housing payment to your current housing expenses and debt obligations. The mortgage debt may also make it harder for you to qualify for rent wherever you're moving. There are other factors to consider. The market may be soft, which means the homes are not selling well, and it could take you a long time to sell the home. Or the housing market is in a downturn, and you would lose money if you sold the home. Like any investment, buying a home is a risk, and you may build equity but your home value is tied to the market, so it could also lose value, and you could end up owning more than the home is worth. Once you buy a home, you can't call your landlord when something breaks. You'll be responsible for scheduling the repairs and covering the costs. Mortgage loans typically include a provision that you must maintain your home in good condition. This includes the house and the yard. And if you don't, then the lender can make the repairs and charge you with interest, or can foreclose on your home if you don't make the repairs after the notice. Now, homeownership is expensive. So it's important that you analyze your current financial situation to make sure that you can comfortably afford all the costs associated with it. Can your budget comfortably sustain all the additional monthly costs you'll have to pay? Are your income and expenses currently balanced? If you are struggling now to keep up with them, then you need to carefully consider whether you should take on the added cost of owning a home. You also want to think is your income stable? If you change jobs frequently or your income varies from month to month, then you'll be at risk of not being able to keep up with all the costs. Do you have enough money in savings to cover the down payment and closing costs? Or would you have a reserve left after paying them? It's important that you don't drain your savings to buy a home, and that you preserve a cushion to protect you. So should you have a financial emergency like a medical expense or a loss of income, you are still able to keep up with all your housing costs, essential living expenses, and debts. Are you currently able to save every month? If you're not, then that's a red flag. Adding to savings every month is always important, but even more so when you own a home. If you have to dip into it to cover, for example, like a maintenance expense, like a roof repair, you must make sure that you are able to replenish it. And how much debt do you currently owe? If you're currently having trouble keeping up with your debts, maybe you have credit card with high balances you're struggling to pay off, then you must carefully consider whether you should add more debt. When you apply for a home, lenders look at what's called the 4 C's of lending: capacity, credit, capital, and collateral, to decide whether to approve your loan application. They want to know, can you afford to pay back the debt, and can they trust you to repay your debt? Now, credit stands for credit history. This is based on your credit report. Do you pay your bills on time? Do you pay your debt obligations? For example, they'll look to make sure you don't have any outstanding debts like collections, bankruptcies, lawsuits, or liens. They also look for credit references. These are accounts listed on your credit report that have at least a 12-month recent positive history. Some lenders accept non-traditional credit references, like your landlord or utility company or cell phone provider. If you're contractually obligated to making monthly payments, they may be able to serve as a credit reference. Lenders also typically have a minimum credit score requirement that you must meet to be approved for a home loan, so they'll check your credit score. For capacity, they look at how much you make, your employment history, and your current debt obligations. They will analyze your income documentation using employer's verifications, tax returns, W-2, pay stubs. They will also check to make sure that your employment history is stable. They usually look at the last 2 most recent years of employment history. Have you held the same job or worked in the same field, or do you jump from job to job, industry to industry? If your employment history is not stable, then they'll regard you as a risky borrower. They will also review your credit report to calculate how much personal debt you currently have. They want to make sure that adding the new housing payment to your current debt obligations will not put you at risk of not being able to keep up. And this is when a debt to income calculation is done. And we'll go through an example in a little bit. Capital means they'll look at your bank statements to make sure you have enough liquid assets to cover the down payment and closing costs. They'll also make sure that you'll have a saving reserve after covering them. The amount of reserves needed vary by lender and loan type, but they're usually measured in months, meaning the number of months of housing costs that you'd be able to cover with your savings. Lenders also look at collateral and require a home appraisal. They want to make sure that the value of the home backs up the loan amount that they would extend you. If the home appraises for less than the purchase price, then their investment's not protected and they will not approve the loan. That's because if you don't pay and they foreclose on your home, they will not be able to recoup the money they lent you from the proceeds of the sale. So knowing what impacts your credit score will help you understand what you can do to help improve it and maximize your chances for loan approval. Also, the higher your score, the better interest rates will be quoted. Experian, Equifax, and TransUnion are the three main credit reporting agencies. Your creditors and lenders report your credit history to them. The bureaus then collect this data, list the information on your credit report, and then assign your credit score. Now, the bureaus do not give us their formulas for calculating the score, but they tell us what it is that we do that can have a positive or negative impact. The largest impact on your credit score is your payment history. Do you pay your debts on time? Do you pay all your debts as agreed? It has a 35% impact on your score. How much debt you owe has a 30% impact on your credit score. This is also referred to as the credit utilization ratio. Borrowers who tend to max out credit cards are viewed as risky, and that's because it's a red flag that they can't handle debt responsibly. So a good rule of thumb is to keep your credit card balances at no more than 30% of your credit limit, which means that if you have a credit limit of $1,000, you should not carry a balance higher than $300, and of course, the lower the better. The length of credit history has a 15% impact on your score. A short history does not mean you can't have a good score, but the longer it is, the more information is available about how you handle debts, which can help increase it. New credit has a 10% impact. That's when your credit report is full because you've applied for credit or a loan. Every time you do that, you're applying to borrow money and your score gets a hard hit and your credit score may go down. Now, how much really depends on how many accounts you have recently opened or applied for. Types of credit used has a 10% impact. There are 3 types of accounts that are reported on a credit report: installment, which are loans, revolving, which are credit cards and mortgage. If you own a home, if you don't have to have all 3, but having what is called a credit mix can help your score, and that's because it shows how you handle different types of debts. You are entitled by law to pull a free copy of your credit report from each of the reporting agencies every 12 months. You can request it from Annual Credit Report, either online or by calling their number, 877-322-8228. Now, this is the official site where you can get your free copies. So be aware of sites that look very similar and ask for payment. It shouldn't cost you anything if you order it from the official site. You can also get additional free copies of your report if you were denied for credit, service, or an apartment or employment. If you're out of work and plan to look for a job within 60 days, you're on public assistance, your report is inaccurate because of identity theft or another fraud, or if you have a fraud alert in your credit file. Now, before you apply for a home loan, make sure you know what is reported. Check your credit report. If there are errors listed, dispute them. If you have high credit card balances, pay them down. If there are debts you owe, like collections, pay them. Fix anything that will help you build a positive credit history and raise your score. To get your free copies, you have to request each bureau's report separately. You can pull all 3 reports at the same time, but if you space out your request, you can get a copy of your report throughout the year. So for example, in January, you pull Equifax, in May, you pull TransUnion, in September, you pull Experian, and then in January, you start with Equifax again. Now, the pre-qualification and pre-approval processes help you assess how much home you can afford, but there is a difference between the two. Pre-qualification is an informal evaluation and can be a helpful step if you're at the very beginning of the home buying process and you just want to get a sense of a purchase price that you could afford. It is based on verbal information about your income, assets, things like that, and no documentation is required. Depending on the lender, though, a credit review may or may not be required. Pre-approval has more weight. The lender makes a conditional commitment to grant you a loan. Typically, you would go through this process if you're actively shopping for a home but have not yet found one you want to purchase. In this case, you provide documentation. Every lender is different, so you need to find out what you need to do and what documentation is required. The lender makes a conditional pre-approval based on actual verification of income, credit, and assets, through a review of bank statements, pay stubs, tax returns, W-2s, credit report. You then receive a pre-approval letter, which will likely have an expiration date. Typically, that's 90 to 120 days. For this reason, many people wait to get a pre-approval letter until they're ready to begin shopping seriously for a home. A pre-approval letter is helpful to have, especially in a seller's market. It shows that you're serious and that you have a lender who would be willing to lend to you under certain conditions. The letter will say how long the conditional approval is valid for, and it will include conditions, for example, that the home's appraisal value meets the agreed upon purchase price. Whenever you borrow money, you'll pay interest. The interest rate is the annual cost you pay the lender each year to borrow the money. It can be fixed or variable, and it's expressed as a percentage. The rate is determined by a combination of factors, including the state of the economy and personal factors like your credit score and the size of your loan. With the fixed rate loan, the interest rate does not change for the life of the loan. That means that the monthly mortgage payment stays the same as you pay back, and it'll be easier to budget for housing costs. An adjustable rate mortgage loan, also referred to as an ARM, the interest rate is fixed for a set number of years. Once that initial period ends, the rate starts adjusting periodically throughout the life of the loan. Now, the advantage to an ARM loan is that you lock in a lower interest rate for a set introductory period, lower than you would get with a fixed rate loan. The disadvantage is that once that initial period ends, your housing payment will vary and be less stable, and it could also become less affordable because interest rates could go up. The costs that the lender can factor in when calculating a monthly housing payment include the principal, the interest, taxes, and insurance. This is referred to as the PITI. The principal portion of the housing payment goes towards paying back the amount you borrowed. The interest is the fee you pay to borrow the money from the lender, and it's calculated based on your loan's interest rate. The higher the rate is, the more you'll pay for your mortgage over time. In addition, the lender can include costs that will go towards paying back the property taxes and the homeowner insurance. They'll take the annual amounts due, divide them by 12, and then add that amount to the monthly housing payment. If you put less than 20% down as a down payment, you'll have to pay mortgage insurance, so they will add that monthly payment as well. And if the home is in a development that has a homeowner association, the lender will factor in the monthly HOA dues. And this is when the PITI becomes a PITIA. All right, let's pause a minute and let's do a little knowledge check on some of the information that we just reviewed. And what you can do is on the chat box, maybe write in answers. I'll ask some questions, just 3 questions. And then just write in the chat box some questions that, or answers to the question. So what are some things that you need to carefully consider before buying a home? Review this at the beginning. Some things you remember. What should you carefully consider before you buy a home? Any ideas?
You can type them in the chat.
You can go ahead. Yeah, just use the chat box to type in. All right, how about I get it going? How about the increase in monthly housing expenses? That's one thing that you need to carefully consider against your budget. Can you afford those increased monthly housing expenses? What are some other things? We talked about advantages, but also some disadvantages that, or things you, disadvantages.
I remember one.
All right, go for it.
I think home insurance.
Absolutely.
Might be more expensive than the rental insurance, right?
Absolutely. And required.
Yes.
Yeah. Yes.
What else?
What are some other housing expenses that you would have as a homeowner that you would not have as a renter?
Nothing? Let me see. I see some. Oh, it says the chat box is disabled. It shouldn't be.
Oh, okay.
But I'm sorry, I'll fix that. There is income, credit, and savings. Okay, let me see. This is a this is the library's Zoom account. I'm not sure if previous coworker did any changes. I'm sorry about that, but you can type them in Q&A if you want to until I fix that.
All right. So Nevin mentioned.
Maintenance and repairs.
Absolutely. Yes.
I see that one in the Q&A.
Mm-hmm.
What
Yes.
else? Appliances.
Yes, you would.
High
Yeah.
initial cost.
Mm-hmm.
These are really good
These are good.
answers, I guess, right?
Yeah. Yeah.
Perfect.
Yeah. Perfect. All right. Question number 2. What do lenders look for when you apply for a home loan? We
Again,
went
in
on.
Q&A box, please type them in Q&A box. Yeah, I see them.
Yeah.
Okay, credit score,
Mm-hmm.
credits, down payment.
Mm-hmm. Yeah, that you have enough, right, in your savings to make sure
Yes.
you can afford the down payment, the closing costs.
Again,
Anything?
credit score, existing loans, stable saving.
Mm-hmm. Yeah, that
4 C's.
the 4 C's, absolutely.
Stable
Yeah.
employment,
Yes.
stable income,
Uh-huh.
current
Awesome.
debt.
Current debt, absolutely, all of those.
Perfect.
Great. Perfect. All right, one more. Why do lenders look at your credit report? What are they looking for?
Payment history, debts,
Mm-hmm. Yeah.
trust,
Perfect.
trust to repay,
Mm-hmm. Yes. Yes. Yes.
evaluate the risk of lending to you,
Mm-hmm.
ability to pay the loan amount.
Yes.
What else? Repayment history, current debt,
Mm-hmm.
stable income.
Yeah, so the income, they'll assess that from your pay stubs and income documentation, not the credit report, but definitely how much debt you're currently carrying. Can you afford to add more debt? Do you pay your debt? So all of those, all the ones you mentioned. All right, that's great. Thank you so much for participating. All right, let's move on, and we'll have another knowledge check more towards the end. All right, so let's look at the debt to income ratio. So the amount of personal monthly debt you carry will impact the housing payment that you can afford. The higher it is, the less you'll be able to qualify for. When you apply for a home loan, the lender will calculate your total debt to income ratio, or DTI. And what that is the percentage of your gross monthly income. And gross monthly income is the income you earn before taxes or pre-tax deductions are taken out. That would go towards paying the new housing payment, plus the total monthly payments you are already required to make on any credit cards with balances and any loans that you might have, like auto loans and student loans. Lenders have a maximum total debt ratio requirement. Typically, that's 43%, which means that no more than 43% of your gross monthly income can go towards paying all your monthly debts, the new housing payment, and plus your current debt obligations. And that's to make sure that adding the housing payment to your current debt will not put you over the edge. So to calculate your total DTI, the lender divides your total monthly debt payment, again, including your monthly housing payment or the PITI, plus any applicable HO dues, plus the total monthly payments you are already making on your current debts, and divides that by your monthly gross income. And the result is your debt to income ratio, or the percentage of your gross income that would go towards repaying all your monthly debts, the housing payment and current debts. So let's look at an example. In this scenario, this home buyer found a home they want to purchase. They apply for a loan, and the lender's maximum DTI guidelines to qualify is 43%. Now, this person's financial situation is the following. Their gross monthly income is $5,000. The credit report shows 2 credit cards with balances and 1 car loan, and the total monthly payment they're required to make on these debts is $250. Based on the purchase price of the home they want to buy and the loan terms, the lender calculates that the monthly housing payment is $1,900. So the lender wants to know, can this person afford this payment? Would adding $1,900 to their current required monthly debt obligations put them over the 43% DTI? So to do the calculation, the lender adds the $1,900 to $250, which equals a total monthly debt of $2,150. And then the lender divides $2,150 by the home buyer's gross monthly income, which is $5,000. And the result is 43%. 43% of this person's monthly gross income would go towards paying both the housing payment and their current monthly debt, which is within this lender's guidelines. So in this scenario, this person would meet the lender's DTI requirements. Let's look at another example. In this scenario, this person is at the beginning of the home buying process and simply wants to know what would be a housing payment they could afford. So they go to a lender to do a pre-approval, and this is their situation. The lender's maximum DTI is 43%. The applicant's gross income is $6,000 a month. The lender pulls the credit report and finds to credit card with balances and their minimum payments total $90, the car loan with a $300 monthly payment, and a student loan with a $150 monthly payment. They add up all these monthly debt payments and calculate that they total $540. So to calculate a maximum housing payment this applicant can afford, the lender divides their $6,000 monthly gross income by 0.43, which equals $2,580. This is the maximum amount of monthly debt payment this applicant can afford to meet the lender's 43% maximum DTI requirements. The lender then subtracts $540 from $2,580, which equals $2,040. So $2,040 is the maximum monthly housing payment this applicant can afford based on their gross monthly income and the total monthly debt payment they're currently paying. To get an idea of a monthly housing payment you can afford based on your income and current debt load, you can also use online mortgage calculators like Zillow or Bankrate.com. These calculators will also break down an estimate of all the costs, including the principal, the interest, the property taxes, homeowner insurance, and mortgage insurance if you cannot put 20% down. So try them out and then ask yourself, is this a payment I'm comfortable with? And remember that a housing payment that you're comfortable with is ultimately based on your specific financial situation, your budget, your lifestyle and goals, and not on what you would qualify for. Now, there are two main types of home loans, conventional and government insured loans. All are issued by banks, credit unions, and other approved lenders. However, there are some major differences. Conventional home loans, because they're not government insured, pose a higher risk for the lender. So the credit and income requirements are stricter than for government-backed loans. These types of loans are an option for borrowers with good or excellent credit and who can make a larger down payment. A government-insured loan is backed by one of three federal government agencies: the Federal Housing Administration, or FHA, the U.S. Department of Agriculture, or USDA, and the Department of Veterans Affairs, or VA. With these types of loans, the government agency is not the direct lender, but the agency promises to repay the lender if the borrower fails to do so. So the lender's risk is reduced. That makes lenders more willing to approve loans in situations when a borrower might not otherwise qualify. And these types of loans have less strict requirements, credit requirements, and the minimum required down payment is also lower. But to qualify, the home buyer must meet the program's guideline requirements, must also work with an approved lender. So let's look at these a little bit more closely. So FHA is part of the U.S. Department of Housing and Urban Development, and these are, again, government-insured programs, loan programs. So FHA, part of U.S. Department of Housing and Urban Development, also known as HUD, and it aims to make homeownership more affordable. FHA offers a variety of loan options that require lower minimum credit scores and down payment than many conventional loans. Veterans Administration loans are designed to help service members, veterans, and eligible surviving spouses become homeowners. USDA loans are for eligible home buyers who purchase a home in a rural area. Now, these are areas that are less densely populated. And the California Housing Finance Agency, or CalHFA, provides both government-insured and conventional loan programs to help low to moderate income first-time home buyers purchase a home in California. There are various programs that help home buyers purchase a home that you can research to see if they would be an option for you. Typically, these programs target low to moderate income first-time home buyers. Some have a lower minimum down payment requirement. For example, FHA allows down payment as low as 3.5%. Home Ready and Home Possible are offered by Fannie Mae and Freddie Mac, and their down payment minimum requirement is 3%. There are also home buyer programs that don't require a down payment. For example, the Veteran Administration Program, USDA, and Habitat for Humanity's Homeownership Program. There are local, state, and national home buyer assistance programs that provide loans to help cover down payment and closing costs. For example, College FA offers these types of loans to California home buyers. Now, these programs come in different forms. Some are grants, then don't need to be, which means that they do not need to be paid back. Others are deferred loans, meaning that the borrower does not need to pay them back until they sell the home, refinance, or pay back the home loan. Some are forgivable loans, meaning that the loan is forgiven over a period of time. For example, if the home buyer lives in the home as the primary residence for a set number of years. They could also include the right for the lender to be entitled to a percentage share of the home value. That means that if you sell the home or you refinance the mortgage, you pay back the loan amount plus a percentage of the home's appreciation, if any. So for example, let's say you borrow 10% of your purchase price through a down payment assistance program. When you sell or refinance, you would pay back the amount you borrowed plus 10% of your profit. Individual development accounts and mortgage credit certificate programs also can help cover down payment and closing costs. IDA programs match the participants' monthly savings contributions. Now, each program specifies towards what you can apply your savings to, but most commonly they're for purchasing a home, education, or starting a business. MCC program, mortgage certificate programs, they help reduce the cost, the amount of federal income tax that you have to pay, which frees up money that you can use towards down payment and closing costs. Now, IDA and MCC programs are tied to available funding and grants, and the best way to see if they are available in your area is to do a Google search. Some cities and counties offer home buyer assistance programs designed to help people who live or work within their boundaries purchase a home. So to see if your city or county offers such programs, visit their housing department website. Some programs help people work in specific professions, like the U.S. Department of Housing and Urban Development, again, known as HUD, offers the Good Neighbor Next Door program to help teachers, firefighters, police officers, and EMTs purchase a HUD home at a discount from the list price. Now, HUD homes are foreclosed properties that were originally purchased with an FHA loan. HUD becomes the property owner and then offers it for sale to recover the loss of the foreclosure claim. And of course, banks and credit unions offer their own loan products. Keep in mind that they may or may not offer a program you may be interested in. And if they do not offer it, they will not offer it to you as an option. This is why it's important to take the time to research available programs and understand how they work so you know which options may be available to you. This way, when you're ready to talk to a lender, if, for example, you want to know if you qualify for a specific program like FHA, then you can make sure that you're talking to a lender that offers FHA loans. All right, well, let's review some steps you can take to prepare to reach your homeownership goal. Attend the first-time homebuyer class so you understand how the home buying process works and what you can do to prepare. Analyze your financial situation, calculate what you can afford, and make sure you're financially prepared to cover the upfront and ongoing costs. If you're not adding to savings every month, set a savings goal. Look at your budget, which expenses can you reduce or eliminate so you can free up enough money, and then set up an automatic transfer to savings. The more you can put down as a down payment, the less you'll have to borrow, and the higher the chances you'll be able to qualify because it lowers the lender's risk. You may also qualify for a lower interest rate, which means your monthly payment will be lower. Calculate how much you're currently paying in your monthly debt payments, and then calculate your debt ratio. What percentage of your gross monthly income is going towards paying off your monthly debts? Is it too high? Start a debt repayment plan. The lower the percentage, the higher the housing payment you'll be able to qualify for, and the higher the chance your application will be approved. Check your credit history. Look at your credit report carefully. Are there things you need to fix, like collections you need to pay off, a late payment history you can reverse, errors reported you can dispute? Resolve anything that will show you are a responsible borrower, and that helps increase your score. The more you're informed, the better equipped you'll be to ask the right questions when you're ready to talk to a lender. Research loan and home buyer assistance programs like FHA, USDA, CalHFA, down payment and closing cost assistance programs. Look for, IDA programs, mortgage certificate programs. Are there any available in your area? Any programs you can enroll in? Keep in mind that IDA programs typically require being enrolled for a few years before the savings will be matched and available to you. So you need to plan ahead, understand how all these programs work, what they offer, what the qualification requirements are, and to see if they could be an option for you. Now, if you would like help with learning what you can do to financially prepare for homeownership, consider reaching out to a HUD certified housing counselor. They'll provide step-by-step guidance to help you reach your financial homeownership goals, including how to create a working budget, save, pay down debt, and understand what you can do to improve your credit history and increase your credit score. All right, so let's do another kind of knowledge check, and you can go ahead and also, and again, write on the Q&A box.
Alessandra,
Yeah.
I enable the chat so they can type in chat.
Oh, okay. You can type it in the chat box. Awesome. Okay, so I'm gonna ask this question, and you need to write in if you think it's true or false, this statement. The debt to income ratio, or DTI, calculates what percentage of your monthly gross income would go towards paying the new housing payment plus your current debts. Is this a true or a false statement?
True.
True, true. Yeah, absolutely. Yes. Yeah. All right. So question number 2. When a lender calculates a housing payment a home buyer can afford, which are the costs that they can include? So remember, we talked about the PITIA, which can become a PITIA payment. What does that stand for? Those are all the costs that they can include. Any ideas?
I
Principal
see.
Mhm.
Yeah, do you see the chat?
I do, yes.
Okay,
I do
perfect.
see the chat. So principal, interest, taxes, insurance, awesome. Principal, interest, taxes, yes. That is PITI. And HOA, if there's an HOA, then it becomes the PITIA. They will include that payment because HOA payments are required. Even if you make your monthly mortgage payment on time all the time and you don't pay your HOA, you could be foreclosed on. So the lender wants to make sure you can afford that payment. They don't want you to foreclose. They want you to do well. And keep up with your payments. All right, next statement, true or false? A government-backed loan, home loan, is a loan that is guaranteed and insured by a government agency. Is this true or false? True. Yeah, true, 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 true. Absolutely. All right, one more. Pre-qualification. So again, true or false? Pre-qualification is an estimate of how much you can borrow based on verbal information. And pre-approval is a conditional loan approval based on verified information and documentation. Is this true or false? True, true, yes. And keep in mind that pre-approval, you're not applying for a loan, okay? So that does not mean that you've been approved for a loan. It just means that this lender did a preliminary review and they indicated that they would be willing to lend to you under certain conditions. But then once you apply for a loan, there's a lot more review that goes on. All right, well, we can move on to Q&A. Just wanted to quickly kind of tell you, I think the email you're going to receive from Nevin's going to also have a link to our own, we have our own workshop evaluation. It's an anonymous form you can fill out that lets us know what you thought of this presentation. We do encourage you to complete this form. We really appreciate the feedback. We read them, we look at them. That's how we are always improving on our presentations. We want to hear the good, what you liked. We also want to hear things that you think we can improve on. It's a very quick thing. You follow the link, fill out the form, click submit. That's all you need to do. So just wanted to kind of run by that real quick. And then also, I do want to encourage you to visit our Financial Education Center. I'll send Nevin the link to it. But this is a kind of a self-paced financial education resource that you have. It's a series of lessons that you can take 24 hours a day, 7 days a week. They're short lessons, 3 to 10 minutes tops, and they cover all kinds of personal finance topics, including buying a home, including some stuff about mortgages and home buying process, and also planning for retirement and saving and all kinds of really good stuff. So I encourage you to check it out because it's there for you for free. And you don't need to create an account. If you want the system to remember your progress, then you do need to create an account. And it's a quick setup, literally just pick a password, answer a few quick questions, and then you've got an account, and then you can just pick up wherever you left off. But if you don't want to create an account, you can also use it as a guest user. And Nevin, I'll send you the link to the center. And this is my contact information. There's my name and my email and phone number in case you want to reach out. If you're interested in one-on-one counseling, I'm happy to talk to you about what we could do to help. And I'm ready for questions. Any questions?
Thank you, Alessandra, for the great
Yeah, thank you,
information.
Nevin.
Let's move to the Q&A session.